So I did a brief presentation last week. I added a little bit for the show here today and took out some, but I'm just gonna do a little bit on that just to give you an idea of why we really do focus on growth and profitability. I'm going to show you a study in that area and some of the key variables that were in that study that proved kind of why we look in this area. We started about 25 years ago looking at small cap stocks. And when I say that, I don't mean tiny businesses, but those with market caps of say under 500 or 250 million in the Canadian market, a billion in the US market at the time, right down to stocks that are 10 to 20 million in market cap. So real micro or nano caps. These segments are underfollowed. They can grow faster. And here you can find mispriced stocks. It's core to our philosophy is to uncover and invest in wonderfully profitable businesses. Profitability is a basic requirement in every investment, as well as growth from those businesses. But why do we focus on that profitability? Well, I'm going to get into that today. There was a study done recently by Henrik Wessenbinder. Just call him Hank here. It's a lot easier to say. He's a rather acclaimed finance professor. He studied whether stocks beat T-bills long term. His answer was a qualified yes. The study looked at 26,000 stocks from 1926 to 2015. He analyzed long-term stock returns. He examined 20 variables. Only 3 of those variables were really found to be statistically significant. The most significant variable was net income growth. Not because of this study, but we do know this as a driver of stocks. But this is why we see net income grow and growth in that income as core tenant to any investment that we make. So on the flip side, one of the areas that I look at specifically is profitable Canadian and US small caps. But why do we look at profitable small caps? Your question might be. Well, let's look at a study over the past 10 years period, returns, for example. If you look at 87% of all global equities that went up 1,000%, those are the type of stocks that can really drive your portfolio. Everybody's looking for those 10 baggers. So over the past 10 years, 87% of them started off as micro or small cap companies. 82% of those were profitable at the start of their ascent, and 91% had some history of profitability. For us, the key is combining small, growing, profitable, good businesses. This is kind of what we do in our research. I always like to give examples of how powerful combining low price and low valuation, profitable and growth stocks together can be. This is an example of one. Again, it's the best performing stock in Canada over the past 5 years. Most Canadian investors have never heard of this stock. Why? Well, Hammond is a leading provider of electrical transformers, and it's a company we've long seen as kind of a backdoor way to play the electrification boom. Love it or hate it, it is here. It has historically been profitable and has grown out of internally generated cash flow. Hammond has never needed big banks or brokerage money to fund its operations. These are the best types of businesses, but Bay Street pays them little attention, and it's the detriment of Canadian investor portfolios. But we can take advantage of opportunities like this, and that's a great example of a company who has had a tremendous outperformance, started as a small cap, and is now graduating to be in at least the mid to cap range in the Canadian market. Now, I'm going to look at a little bit of background on Hank's study that we talked about there. Just kind of what compelled him to do this study to start with. Well, Wessenbinder got into the stocks versus treasury bills question really accidentally. Initially, he was looking at data on continuously compounding returns for stocks and noticed that the average was negative, meaning that a lot of stocks were losing money. So he didn't understand how that could be, given the fact that the overall stock market does make money in the long term. So he wanted to know why. His investigation ended up documenting the importance of the statistical concept of skewedness for the stock market and investing in general. In particular, he found out that returns from long-term stock investing are positively skewed, meaning that very large returns in a few stocks pull up the average, while most stocks post modest or negative returns. So here are from the study, some of the biggest points that he found. Because of skewedness, he found that here you see Treasury, 58% of stocks failed to beat Treasury bill returns over their lives. 38% of stocks beat Treasury bill returns by just moderate amounts. And just over 4% of stocks are responsible for boosting the market's overall returns higher than those on Treasury bills. So it's kind of shocking to some people to see that. But if you look at the returns, if we can look at the top 20 wealth creators over this study period, you can see here some of these names you should be very familiar with, some of the biggest companies out there. But if you look at Apple, this was again up to 2017, not the 2015 that I quoted. There's 2 more years added on to this, but Apple has generated more wealth in the stock market than Exxon, despite being 50 years younger. Now, those numbers for big tech that you see on this list here have gotten even larger. They look even more impressive today. But you can see these long-term winners and how they have created much of the wealth in the market over time. And one of the things we say, it does not take many great stocks in your portfolio to make a monumental difference over the long term. Having just 1 or 2 of these stocks in your portfolio over the past 40, 50 years could have been monumental in terms of driving growth. And that's what we're looking for every day, starting with good, profitable businesses that have the potential to grow over the long term and power the returns in your portfolio. They also allow you to make mistakes on other firms, because you will make mistakes on other investments in your portfolio. But if you have a great long-term winner, it can power your portfolio and help you over the long term. All right. Any further?
One thing that I'll note is that on that last slide that you showed, that data was up to 2017, and it had Microsoft at a $800 billion valuation market cap. That's
it is amazing.
Now in 2024, almost 3.2 trillion, right? Yeah. So it's those numbers would even look better if
Alphabet was just over 500 million. Even Alphabet or Apple at $1 trillion. Amazon at just the same range of Alphabet there, 550 billion. But just the gains that have been made there, these returns, the power of these returns from these companies has created far more wealth. That it was impressive at this point. It's the skewedness in terms of the market has been even more impressive over the last, just to add 5-6 years to that. So.
Yeah, I'm glad that you did this segment, just because, the company that I'm doing, this small cap or this nano cap company, the stock is up over 300% since I covered it last on the podcast. And it
can't believe it's not on that chart.
Yeah, well, it's tiny, but it is, earnings per share growth that has been driving the stock. And obviously I'll get into that, but I just, again, that's what we're looking for. Not only being, earnings positive, but also having growth. And that's going to be the big question around my segment is, will this growth continue? Anyways.
Well, and we see that. I mean, maybe we can do a segment at some point talking about like EBITDA and those other, how they tried to use those on a per share growth basis. And the basic, this study, over from 1926 to 2015, the biggest variable was just basic net income growth that over time, and that is over the long term, but that was the biggest variable in terms of impacting the driving the share prices. So it's one of the reasons we pay attention to it. Again, not because of that study, but just from looking at the markets for 25 years and seeing which stocks from our research, outside of our research, actually grow over the long term and power those returns that we're looking for in client portfolios. And it's companies that move the needle on net income growth, cash flow per share growth, all of those things.
Yeah, and interesting enough is when we think about bubbles like the 2001 tech bubble, when what happened was we deviated off net income, and cash flow into sales or clicks or something like that, alternative metrics.
Those are the
aren't used.
scariest times
Yeah.
for me when I look at the markets, without a doubt. Yeah.
Yeah. Well, like,
it's
I mean,
hard at the time when you're in the market to, well, maybe we should have a new metric that we use. Maybe we shouldn't, but it always reverts back to,
yeah.
the growth in the profitability on a per share basis.
Like, I mean, it's like CloudMD. I mean, we're just running the segment up and up here, but like CloudMD, which, I did last week on the podcast. I even said in my segment, there was people trying to justify that this thing, it was trading at 9 times sales, and they were saying that CloudMD should be trading at 15 times sales. So it's just, again, it was in this crazy environment. And yeah, it's hard, when you are in it to, see the forest through the trees, I guess.
Yeah. You just got to read those studies over and over and just keep looking at them and know there's times to buy, not times not to buy. You buy less at those times or very selectively.